If you're going to be a successful business owner, you have to really have a clear idea about recording transactions in a journal. Maybe not do it yourself, but have a clear understanding of how things are done in the background, right? So, in today's conversation, I want to give you a quick step by step guide to recording transactions in a journal, okay? The thing is that one of the keys to a successful business is actually having accurate financial records when you reach out to investors, when you reach out to lenders, when you reach out to regulators. That really builds credibility. So the foundation of your business depends on having accuracy in your financial records. So understanding how to record transactions in a journal is not just an important accounting task, it's a skill that helps you manage your finances with confidence, okay? So in accounting, journal entries document every transaction in your business, ensuring that nothing slips through the cracks. And that's important. Completeness is important. Thoroughness is important, okay? So by keeping your books up to date, you will set up yourself up to monitor cash flow, track expenses, and protect your company's financial health, okay? So let's first talk about understanding journal entries. Journal entries form the basis of your financial accountability. So using the double entry bookkeeping method, you will actually record every financial action twice. So every transaction, you have to really record it twice, once as a debit and once as a credit. So that's really the double entry bookkeeping method. So this approach ensures an organized record that reflects the core accounting equation. What's the core accounting equation? Well, assets equal liabilities plus equity. So your company's assets, total assets, will equal your company's total liabilities plus your company's total equity. So what makes up a journal entry? Well, you have the dates. Here you want to mark when the transaction occurred, the description. Here you have details about what the transaction involves, the reference number, which basically you are assigning a unique identifier for tracking purposes, okay? That's important. So you also want to understand that the double entry accounting system is a method that makes sure every financial transaction is recorded in at least two different accounts, maintaining the accounting equations balance that I gave you a little earlier, okay? So every entry is recorded as a debit in one account and a corresponding credit is made in another account. So if you are trying to record transactions, you have to become familiar with something called debits and something called credits. Okay, so the entries from the journal are then posted to, when you actually have transactions. The entries are actually posted to the general ledger, where all credits and debits are tallied. So when you think about debits and credits, T accounts, also known as ledger accounts, are basically representations of individual accounts that are important for recording and visualizing debits and credits. Okay, think of it as a roadmap, as an accounting roadmap that actually puts your company on a financial on a solid financial let's say a cornerstone. So every T account resembles the letter T when it is drawn on paper and records the changes of a particular ledger account. So again, for every financial transaction, there are two sides that you need to consider: a debit entry and a credit entry. Okay, let me give you a simplified guide to their relationship. So you have assets and expense accounts, and then you have liabilities, equities, and revenue accounts. So for assets and expense accounts, you want to increase with the debit entry. That's actually the left side of the T account. And you want to decrease with a credit entry. That's the right side of a T account. So in let's say when you represent a T account, an increase is always at the left side of the account and a decrease is always at the right side of the account. So that's for assets and expense accounts. What about liabilities, equities, and revenue accounts? Well, you want to increase with a credit entry. So this is actually the right side of the T account. And you want to decrease with a debit entry. That's the left side of the T account. Okay. So you can see that when you actually flip it over from assets and expense to liabilities, equity, and revenue, things are different, right? What's really, let's say, one way with assets and expenses is actually another way when you actually think about liabilities, equity, and revenue accounts. So I want you to keep that in mind. So let me give you the overview of account types here because it's important to have a clear idea about what assets are, what liabilities are, what equities are, what equity accounts are, revenue accounts are, and expense accounts. Okay. So what happens here is that in accounting, all business transactions are recorded in specific types of accounts. And by the way, what I'm telling you here is not just about the accounting in the U.S. It's the same thing about accounting in the UK, in Australia, in Nigeria, in Brazil, in Argentina, whatever, in Germany, whatever. Okay, it's actually a universal law. So all business transactions are recorded in specific types of accounts. Each account type is important because it really categorizes every financial activity of the business. So there are 5 essential account types. So asset accounts, this includes resources owned by the company that have value, such as cash, inventory, and equipment. So assets are expected to provide future benefits to the business and help to build the financial foundation of the company. So you have short-term assets and you have short-term liabilities. If you really incorporate the timing factor, you have liability accounts. So liability accounts record what the company owes to others. So debts and obligations like loans, accounts payable, and mortgages. Here also you have short-term liabilities, and you also have long-term liabilities if you incorporate that timing factor. So short-term is anything that's less than 1 year, and long-term is anything that's over 1 year. You also have equity accounts. So here, those accounts reflect the owner's claims to the business resources after liabilities are paid off. This includes the owner's capital, retained earnings, and stock. Next, you have revenue accounts. These are accounts related to the income the business earns from sales, services, or both. And then you have expense accounts. This represent the money spent or cost incurred in a company's effort to generate revenue. So this can actually range from utility bills to office supply expenses. So these 5 account categories form the backbone of your company's financial statements, impacting business decisions and financial health assessments. Okay. Now, keep in mind though that employing short and precise bookkeeping in those accounts is not just a regulatory requirement. It's actually a way to keep a clear financial picture, promoting actually informed decision making and long-term business success. And I don't care where you are at, whether you are in the States or you are like in another country. You want to have this sort of foundation. So let me talk to you about the process of creating a journal entry this year. So by recording each business transaction, you actually set up your business financials for success and transparency. And success and transparency are important if you want to talk to regulators, if you want to talk to investors, if you want to talk to lenders, among other stakeholders. Because sometimes you might have to talk to vendors, you might have to talk to suppliers, you might have to talk to customers also. So recorded transactions provide the details you need for all financial reporting and analysis. Let me walk you through the 4 important steps that you need to really have in mind if you want to accurately document your company's fiscal activities. First, you want to gather relevant documentation. Next, you want to analyze the transaction. Next, you also want to record the debit and credit. And finally, you want to include a description of the transaction. So, step number 1, you want to gather the relevant documentation, right? So the thing is, every financial transaction has a supporting document or digital record that serves as proof. You got to have proof. Otherwise, how can you justify the transaction in the first place? Okay. So the proof can be paper or it can be digital. So this can be a sales receipt, can be an invoice, can be a bank statement, can be a payroll record. Your first step should be to collect those documents and put them in a safe place. It's just a lot better to have things digitally nowadays so that you don't have to really crowd your office with paper or with paperwork all the time. Next, you want to analyze the transaction. So with your documentation at the ready, you should then analyze the nature of the transaction. You'll need to identify which accounts are affected and determine whether those accounts should be debited or credited. and you want to record the debit and credit. So enter the transaction into the journal by posting the appropriate debit and credit amount to the correct accounts. Remember the basic rules: assets and expenses are increased by debits and decreased by credits, while liabilities, equity and revenues go the opposite way. Finally, you want to include a description of the transaction for reference purposes. Now, let me give you examples of common journal entries so that you have a clear idea how to really structure things in your company this year. On the screen, I'm going to show you 4 common types of journal entries that you might encounter, especially if you are trying to structure your accounting. And again, those journal entries don't depend on your industry. They are irrespective of your industry, by the way. So you have sales, you have purchases, you have cash receipts, and you have a payment of expenses. So let's talk about sales first. So when a company makes a sale, it records a debit entry in the accounts receivable account and a credit entry in the revenue account. So this reflects the increase in receivables and sales revenue accordingly. Okay. So remember, to increase an asset's accounts receivable, you want to debit it. To increase a revenue account, you want to credit it. So what about purchases? Well, for purchases, especially on credit, the purchase or expense account is debited and accounts payable is credited, indicating an incurred expense and a liability to pay in the future. So basically, if you have accounts payable, this is a liability account. So you credit a liability account to increase it, and purchase is an expense account. So to increase it, you credit it. Okay. Then you have cash receipts. So upon receiving cash, the cash account is debited, reflecting the increase in the assets. The corresponding credit entry could be to accounts receivable, for example, signaling that an open account has been settled. So again, cash is an asset. So to increase an asset, you debit it. Okay, and so when you debit cash, for instance, you got to really show the source of the cash, right? So if it's accounts receivable being an asset, to decrease it, you have to credit it. Maybe you got the cash from a loan, for instance. So loan is a liability. So when you credit a liability, you are increasing the liability. You also have payment of expenses. So when an expense is paid, like an office supply purchase, it entails a debit entry in the expense account and a credit to cash or accounts payable, decreasing the cash or liability, respectively. Accounts payable is a liability, so to increase it, you have to credit it, okay? And an expense purchase is an expense, so to increase it, you have to debit it. Let me give you a few tips for accurate record keeping. So to hone your bookkeeping proficiency and maintain precise records, you got to really think about a few tips. First of all, you want to stay organized. You want to take the time to understand the nature of each transaction. You want to embrace the power of technology. You want to regularly schedule internal audits, and you want to invest in training. Okay. So when I speak about staying organized, you want to really keep documentation in order to categorize transactions as you go. So modern accounting software like QuickBooks, like Quicken, like Xero, like Wave can be invaluable in managing and automating the process. You want to take time to understand the nature of each transaction. So does it involve accounts payable, accounts receivable, asset accounts, or expense accounts? You will need to fully understand the transaction to make sure you are recording it correctly. So embrace the power of technology. So use accounting software like QuickBooks, Quicken, Xero, Wave, okay, FreshBooks to prevent manual errors and streamline the recording process. So features like automatic calculations and syncing with bank records can actually be lifesavers. You want to regularly schedule internal audits to ensure entries are complete and conform to accounting standards, especially US GAAP if you are in the States. So this practice can also detect problems that might suggest errors or misconduct. Maybe it could be fraud or it could be asset misappropriation. and you want to invest in training. So being familiar with current accounting principles and software features can actually make a significant difference in the quality of your bookkeeping. So by ensuring those best practices, those five, you can sidestep common mistake and keep your finances in order. Okay. Now, professional level journal management is not just about compliance when you think about it. It's about gaining control over your business's financial health and making informed decisions that actually foster stable growth over time. And that's what you want. You want to have stable growth over time. Okay. So bottom line here is what? If you want to really avoid common mistakes, make sure that you understand that in bookkeeping, small errors can turn into urgent financial issues. So one common problem is actually mixing up the debit and credit columns. Always remember, the debit side increases assets and expenses, and the credit side increases liability, equity, and revenue. So it's important when you are thinking about recording transactions in a journal to pay attention to the role of accounting software. So accounting software can really help you big time because the software will make the task of manual journal entry in bookkeeping much easier and faster and more efficient. Okay, that's what you want. So if you want to automate key aspects of the accounting cycle so that you can really go on running your business, because you're not an accountant, you don't want to really waste time really doing accounting entries if you don't have cash right now to hire a bookkeeper or hire an accountant or even subscribe to bookkeeping software. Just think about doing things yourself. So the thing is, by automating key aspects of the accounting cycle, you are able to use accounting software to take care of financial transactions quickly and accurately. So what are key features that accounting software is bringing to the table? You have chronological order, so transactions are automatically dated, keeping records organized. You have reference numbers, so each entry is tagged with a unique identifier, simplifying future audits and reviews. You have automatic syncing, so the software can connect to financial institutions such as banks and credit cards to import transaction data automatically, avoiding the possibilities of errors introduced during manual data entry. And you also have automatic calculations. So the software computes totals, reducing the risk of calculation errors. Okay, and what you want to do here is that you want to really have a software that actually integrates financial accounting processes from accounts payable and receivables to automated financial statements. You want software that simplifies complex tasks such as reconciling expense accounts, tracking receipts, and ensuring the accuracy of financial reports. You also want to have accounting software that ensures adherence to the double entry accounting method, maintaining the integrity of the accounting equation, which is really a keystone of accurate financial reporting. And again, this is not just about reporting in the States. Financial reporting in the States is it's about reporting internationally too. So whether you want to comply with a US GAAP or IFRS, having this ability to have the double entry accounting system is going to be quite essential for your company's financial integrity. Okay, so remember that you have the possibility to have accounting software do the job for you, or you have the possibility to hire someone. You can hire a bookkeeper or an accountant, or you can do it yourself if your transactions are not too quote unquote sophisticated. So the closing arguments in today's conversation, I'll just give you a step-by-step guide to recording transactions in a journal. I explain to you what debits and credits are. I give you an overview of account types, the process of creating a journal entry, give you a few tips here and there to accurately record your transactions, and also how to maintain up-to-date financial records. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.